Most business owners I meet are doing taxes, not tax strategy. They file the forms, they pay whatever the software spits out, but they have no idea that just three levers, entity structure, hidden deductions, and the new 2025 tax law changes could be worth $20,000 to $40,000 every single year. Over 10 years, that's $200,000 to $400,000. Same income, different decisions. I'm Tony Hong. I'm a licensed CPA for 10 years and the founder of the CPA Dude. My firm handles tax strategy for over 800 business owners a year. And when I review returns, I see the same money leaks over and over again. In this video, I'm going to show you on the whiteboard with 2026 numbers exactly how those three levers stack, what it's costing you, even if you ignore one of them. Quick disclaimer, this is education, not personalized tax advice. Talk to your own pro before you change anything. All right, so I got this broken down about what you are using today or your CPA's using that's hurting you. 2 is what you should use. This is where the money is gonna be. And number 3 is we got the cost here, AKA how much money could you be saving or what you're losing today. All right, so let's start off here about what are you using right now? So what I see generally speaking is that you're a single member LLC or you're a sole proprietor. To the IRS, those are the exact same thing. Some people think LLCs save you money on taxes. Sorry, they save you jack squat. So you set up an LLC online, you went to LegalZoom, you checked the box, and you never optimized anything. The result? Full self-employment taxes on every single dollar that you earn. That's Social Security and Medicare on both sides, with your head getting smashed in the middle because you're the employee and the employer. So instead, let me give you a framework of what you need to follow if you're a sole proprietor or a single member LLC, not taxed as an S-Corp yet. So if you're less than $50,000 net income, stay over here. You're gonna get killed on the maintenance costs of an S-Corp. Now, the next level is gonna be $50,000 to $80,000 of income. This part, you're kind of in a tricky situation. You have to run the numbers right here to see if it makes sense because you have to outweigh the payroll and the S-Corp cost. Now, the easy part, and this is smooth sailing here, $88,000. You make more than $88,000, you have to become an S-Corp or you're just burning money on the table. And this one, this is where you really start winning the tax game. $200,000 or more, you're going to be getting so much more benefit just because you can stack more strategies on top of it. This is what this video is going to be about. And I want to say you don't need a new entity. You keep your LLC. You just file the form. All it is the form 23. This essentially just tells the IRS, hey, I'm a pig, put the lipstick on the pig as an S corporation. I want to be taxed as an S corp because the S in S corp stands for small businesses. All right, now let's go talk about the cost of all this though. So we've gone over LLC, should you become an S corp or not? The cost is bad here. So I'm going to use an example, $300,000, right? This $300,000, if you do not have the right entity, you're going to be losing about $20,000 extra per year because you have the wrong structure. Over 5 years, you're smart at math here, that's $100,000. Over 10 years though, oh my gosh, that's $200,000. What would you do with $200,000? And this gets worse the more money you make. So that's at $300,000. Now let's go into how much you're losing if you had $400,000. You're gonna be losing about 23.8K per year at this point. Once again, 5 years, about 119 grand. At 10 years, 238 grand. This is just bad. Now, let's just say, you're a super successful business owner. You're making $500,000. And at this rate, 25K plus, just gone out the window. And these numbers are before we layer any deductions and the new 2025 tax law changes. This is just structuring, my friends. Okay, so all right, so here's what I actually find on real returns when I'm going over business returns, generally about $300,000. So the first one is gonna be the home office. I know as entrepreneurs, you are always working, my friend, and you're using some part of your house. This does have to be exclusive use though. But hey, this could be anywhere from 10 to 25% of your rent or your mortgage. This will also include your utilities like your internet, your electricity, and then this also will include insurance too. Anything that is used to operate your home, you can prorate part of this. This typically, I find about 6 to 18,000 in extra deductions. Next one that I have here that I see a lot is mileage. Last I checked, you got to go from point A to point B to meet clients. And with the new mileage rate this year, it's 72.5 cents per mile that you drive here. So if you're driving 5 to 10,000 business miles a year, that's $3,000 to $8,000 of extra deductions every single year. The next one that I see here is your cell phone. You're always using your cell phone for something, whether it's doom scrolling or actually doing real business. And you have to prorate part of this here, maybe 70 to 80%. Maybe you actually have a real business dedicated phone. That's going to be 100% for sure. This can easily be about $800 to about $1,500 a year from what I see. Next, and one of my favorites, even though you only get 50% of this, is client meals. So if you're taking out potential prospects, taking out your team, you can write off 50% of that, easily to the 5K, depending on how fancy your taste is. The next part, and which one I thought was a little bit underlooked, was actually conferences. So I didn't really believe in the woo-woo stuff, but once your mindset's in the right place, you're actually going to elevate to the next level. So going to conferences, easily 2K to 10K a year, good investment. It's hard to actually measure ROI. I think the accounting side of me got the best. I'm like, dude, all I can see is the cost. What actual tangible ROI can I get? Didn't get it, but I did meet a lot of great people. And one of those cliche phrases that are actually true is that your net worth is equal to your network. So if you don't got a good network, it's time to start building one. This one, and this is fun one, I love this one, is equipment and gadgets. So as you can see, I have a bunch of crap on me. I got an Apple Watch, I got an Oura Ring, I got a Whoop Band on here. Part of these are kind of write-offs, part of these are not, just this one because I just want to use this to check my notifications. But having your new cell phone, the new iPhone, the new iPad, the new computer, you can write all those off. And this one can easily go to 3 to 20K a year from the business owners that we're working with. The next write-off that's hidden that you may not know, but you need to go get is health insurance. I know no one likes this one because no one likes to go to the doctor, but you never know when's it gonna blow up on you here. An appendicitis about 4 years ago, I was just like nosy and I was curious how much was this gonna cost me if I didn't have insurance? My friends, it would have been $50,000. I would have been completely screwed. My good thing though, my deductible was 5K, even though I had no money at that time. And 5K pretty much trained me, but it's better than paying 50K. So health insurance, these premiums per year, these can add up, depending on how big your family is, 6 to 20K that you can have on this side. So cover yourself, cover your family, whatever you can do. This one, once again, no one's favorite. It's like eating your vegetables, but you need to start doing it. Is going to be your retirement accounts. There are huge incentives that the IRS gives you for putting retirement money away. And you can think about it like they are matching you. So you can put up $72,000 a year if you're into your solo 401k as a max. All right, retirement contributions is one of the next slept on strategies. No one likes it, but you need to do it because the IRS will match what you put into it, AKA your tax savings. So you can put $72,000 into that. And for many of our business owners that are in California, they're at the highest rate. They're getting murdered at 50%. But what that means is that if they put 72K into this, the government's going to match them, AKA their tax rate, 50%. So they're going to save 36 grand on tax, just like that. So as you can see here, here are a whole bunch of examples, easily from 30 to 100K plus. That's many business owners are just leaving on the table. So going back up here, if I go, oh, wow, we had a whole bunch of tax strategies that we had going on in here, is the tax impact. So the tax impact, let's just say we go somewhere in the middle of everything I just told you, say $60,000 of deductions that you may or may not be getting today. And that's normal for anyone making $300,000. And assuming about a 32% tax rate on this side, this is roughly about 19K that's being left out on tax savings. And don't forget good old Mr. FICA. That's your Social Security and Medicare taxes. You'll save so much on an S-Corp just reimbursing yourself through the good old accountable plan. We got the recent video on that, so go check that out in full depth and detail if you didn't see that video yet. This can easily be another 1.5 to 2K just because you saved the FICA taxes. So call between these right here, I'm just gonna call it 20K easily in tax savings. And you can combine this with your S-Corp structure. That's gonna be about 20K. Add these two up, you're saving $40,000 in taxes every single year. Times 10 years later, and don't be like my parents who made this mistake for 20 plus years. Right here, we got $400,000. $400,000 right here, my friends. This can literally be your retirement account. You have to work so much. $400,000 compounded over time is a ton of money. 2 levers, we still have 1 more to go. All right, on to the 3rd lever. Now let's talk about what changed in 2025 since you've been living under a rock, and it is the One Big Beautiful Bill Act. It's now 2026, my friends. You need to be taking these tax strategies in place right now and grabbing it before letting all your money burn away. So the first change here was the QBI deduction was made permanent. This was gonna go away at the end of 2025, but essentially what this states is that if you got a small business, you're gonna get a 20% discount on your taxes. Just like how you like to go shopping and get discounts, this is 20% off your taxes every single year, as long as you're utilizing it the right way. There are specific limits that we won't get into today, but if you're interested, comment below and we'll make a video on that. And if you're an S-Corp owner making $300,000 and paying yourself a $120,000 salary, this is where you can really start optimizing here. On 300K, depending on your business, 20% of this right here is an extra $60,000 in deduction. At a 30% tax rate between federal and state on this side, we're talking another $18,000 back in your pocket. And if you're a sole proprietor at $300,000, most or all that profit can qualify as QBI. The point is, if you're not using this, you're lighting money on fire. All right, the second change that I have for you here, it's really great for real estate investors and business owners. And what that is, bonus depreciation is now back at 100%. So previously this was gonna phase out and go to 0, but now you can buy equipment, vehicles, computers, furniture, real estate, right off 100% in the first year. Real estate, there's some nuances. So not exactly that, but now you don't have to wait super slow and depreciate normal business property over 5 years. So what you can do is literally buy $50,000 in qualifying property. So let's just say you need a new vehicle, $50,000. Let's just say at the dealership, you gotta do 5K down. You finance the other 45K, assuming this is a 6,000 pound car or more, you can write off the full $50,000, even though you only put down $5,000. You just created a $45,000 write-off out of thin air, but it's not really out of thin air. It's literally stuck in the IRS tax code. And the big idea is this: if you're investing back into your business, the tax code now lets you front load those deductions because they want to incentivize business growth. The third one that I have for you here is the R&D tax credit, full expensing. So essentially what this means is that previously the tax laws wouldn't allow you to write off immediately all the expenses that you had, and you had to amortize it really slowly over time. Now you can immediately grab the whole thing and go grab that tax benefit. So if you're in tech, software engineering, product development, these qualifying research and development costs are back to being immediately deductible instead of being amortized. So this doesn't apply to everyone, but if it's you, especially with the AI wave that's going on right now, everyone's standing up AI companies, this is huge. You're gonna need a CPA who knows how to document this. All right, so let's put it all back together here. So I'm gonna put in a big pyramid for you here, and this is how I'm gonna showcase how this works for you. So we got level 1 down here. This is your entity structure. Like I said earlier in the video here, depending on your income limits, go see if it's gonna qualify or not. This is foundational and huge in terms of how you're gonna save money on taxes. So sole proprietor, going to an S-Corp, say roughly you're about $300,000 here, you're gonna save roughly about $20,000 in taxes. Now I got the second layer. Now that our foundation is super stable, super strong, now we got the hidden deductions that I told you about. I went through that whole laundry list on that side. So if you forgot anything, just go back and scroll and see what you got on there for questions on that side. But there we said roughly on $300,000 of income, I generally see about $60,000 in missed deductions that way. And then at the top of the layer, this is why you always gotta stay fresh with your tax game. You gotta be on top of all the new strategies, the one big beautiful bill act strategies that were just mentioned. And then we had many things here. BI deduction at a 300K S-Corp, that's roughly about 11K in tax savings right there. And that's before we go into any equipment or R&D effects. So let's stack all these here and let's do all the math here. So we got 20 plus 60, we're at 80 on here, plus another 11. Boom, we're at $90,000 of deductions per year over 5 years. Here we go, my friends. $450,000, almost $500,000. 10 years at this point, oh my goodness, 910K, almost $1 million in 10 years. Literally, we're talking about the same income, literally just a different structure and different habits. All right, so let's make this real with a $400,000 business owner. Before, no tax strategy. So what they got going on here is on self-employment taxes, they're getting bent over. So before, no tax strategy on $400,000 of income here. And what we're gonna do first is just literally have self-employment taxes pay a ton here. Self-employment taxes on this side, $35,000. Deductions, they probably at least got 15K of the obvious stuff. Business owners are smart for a reason. They know how to get at least something in here. So these are the deductions that they knew they could take for sure. So on income tax, roughly on this is about $94,000. Add in the self-employment taxes and the income taxes here. This is not looking pretty, my friends. Roughly about 129 grand in taxes right here. So here they're roughly just taking home about 270K. Like, ouch. We ended at 270. Really, like, dang, that hurts. So did they do some stuff? QBI, maybe. Bonus depreciation, not really. Retirement, not set up. So this is actually what we did in one of our tax planning sessions for him here. So here's what we're at. Same $400,000, literally didn't do anything different there. He made the same money, but what we did, S-Corp. This way, he's not going to pay $35,000 in self-employment taxes. What we did instead was pay him a salary of $140,000. Then we took a distribution of 260K, same 400,000, but the way you call it, W-2 versus distribution, is massive for the IRS. Their Medicare Social Security taxes on this here, roughly about $10,000. But now we got them all the deductions that I said. We had the home office. We had the good old mileage. We tracked all our miles with Mile IQ. We actually got him onto a solo 401k so he can contribute as the employee and employer and do a 25% match. We got him the QBI deduction on this side. This was about a $49,000 win for him. And now the income tax dropped down to about $62,000 for him now. So his total tax, the 62 plus all the 10 that I drew all the way up here, bringing this all the way down here, we're looking at about 72K total. And now his take home jumps all the way up to about $327,000. And between here, this is the delta. This is the winnings, about $56,000. In about 5 years, here again, this is about $280,000. 10 years, my friends, my goodness, $500,000. More than that. Same income, different structure, one conversation is all it takes. So here's the takeaway. Real tax strategy has 3 layers. Entity structure. Are you in the right setup for what you actually make? Number 2, hidden deductions. Are you capturing everything you're legally entitled to with documentation that will survive an audit? With AI here now, my speculation is the IRS is going to be auditing left and right. Number 3, 2025 law changes. Are you using the permanent QBI deduction, 100% bonus depreciation, and the rest of the one big beautiful bill rules that were literally written for business owners like you? Most people are doing none of this. A few are doing one. Almost nobody is doing all 3 correctly. If I were you, I'd do this next. Step 1, grab your last tax return. If your net business income is over $88,000 and especially over $200,000, assume there's money on the table. Step 2, if you want to know your exact number, not theory, that's what my firm does. We offer one-on-one tax savings blueprint for business owners. In that session, my team will run audits your deductions and reimbursements, applies the 2025 law changes to your actual numbers, and shows you exactly how you're overpaying and how to fix it. And we keep it super simple. If we don't find at least $3,000 in tax savings, you don't pay for the blueprint and we'll refund you. To book it, click the link in the description, answer a few questions so we can prep and pick a time that works for you. And when you show up, we'll already have your rough savings calculated. If you're not ready for that, hit subscribe so you don't keep making six-figure tax mistakes in the dark. You're already doing the work to earn the income. This stuff is how you keep more of it.